Okay, let's go ahead and get started. Good morning and welcome to today's Tuesday Market Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I'm going to be giving you my thoughts and analysis on the broader market. So before we get started, just our usual disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, we will be kicking off with the major equity indices. New all-time highs for the S&P 500 and the Nasdaq 100, also knocking at that all-time high territory once again. So overall, equities have been quite positive, but small caps have been underperforming. So we'll take a look at the major equity indices. From there, moving on to fixed income and commodities, we'll take a look at the sector rotational model as well, highlighting which sectors are outperforming and underperforming the broader market. We'll take a look at a few subsectors from the previous weeks that we've discussed, and we'll end today's webinar with some bullish and bearish market observations. No new ideas except for one potential earnings play for those of you that are interested. So we'll take a look at that. Now, S&P 500, looking at the SPY ETF, we did see new all-time highs on Friday. Price in small consolidation yesterday, but still maintaining a very strong bullish structure that really kicked off from the very end of October. We could see just how much of a monumental rally it experienced. There was a period of consolidation during that Christmas time, which we normally tend to see anyway, and price has now broken out to the upside. So a few key themes in markets. Earnings season. Earnings season has so far played out very well. Big tech earnings week last week, it seems to have largely been positive. I know there were a few exceptions to that, but we saw how big of a gap Meta made after its earnings announcement. And overall, we are seeing the major indices like the Nasdaq and the S&P push higher. There are less obstacles now in terms of this equity rally because big tech earnings week really does set the tone for the rest of the earnings season. And we've also now gone past the Fed meeting from last week. Not too much volatility for that event, but the next Fed meeting on the 20th of March, that'll be a pretty important one. You know, a month ago, maybe a bit more than that, markets were pricing in a pretty high probability of a 25-point cut. And since then, that probability has diminished quite rapidly. About a month ago, that probability was at over 70% of a 25-point rate cut. Now, based on Fed futures, that probability sits at around under 20%. So that should act as a headwind for markets. It has not. Equities have actually continued to push higher through earnings as a catalyst. And also, you know, despite the fact that the Fed is making slightly more hawkish comments, or maybe hawkish is probably the wrong word, but not dovish. They are not looking to cut interest rates, and the language that they're using is very much to keep interest rates where they are for now for a little bit longer. That hasn't had that negative impact on markets. And you know, once again, the Fed Chairman Jerome Powell has stated that they'll be looking at the data points. There's a few more data points ahead. We have non-farm payrolls for next month. We have some inflation data coming out as well. These will play a big part, but we are starting to see a shift from what investors are looking at. Before, it was investors were almost only looking at interest rate trajectories, looking at yields, and now we're starting to see a more emphasis placed on the actual earnings numbers, which is positive, in my opinion, for equities. And that is why we're still seeing new all-time highs, despite a slightly more hawkish Fed. Now, the Nasdaq 100 is actually, in the last few days, underperforming the S&P 500. It hasn't quite reached new all-time high territory or new all-time highs from a few days ago. It's still at that 430 level. But that should be broken, you know, perhaps even today, and we see a continuation higher. Now, for the Nasdaq 100, we are seeing a slight rotation out of technology. We know that the Nasdaq 100 has a high concentration of technology stocks. Now, I don't view this as a negative for equities or for technology, even in that case, because the short-term rotation that we are seeing out of technology, I think, it's about time. We've had technology leadership for quite a lot of time. It's pushed the major indices to new all-time highs, but the fact that we're seeing rotation out of technology and into the rest of the sectors indicates broadening participation. And that's probably thanks to a pretty decent earnings season so far. So the Nasdaq 100, it does have minor resistance at 430, but again, no key levels to be looking at to the upside because this is new all-time high territory. However, we are looking at potential pullback zones. Last week we identified this area above 410 as a pullback zone. Didn't quite get there, but we did see an initial pullback before continuation higher. That level of support still holds, as well as this previous swing low just below 420. That will be the main area of support for the Nasdaq 100. But the bullish structure does remain quite strong. Momentum remains quite strong. We're not seeing signs of divergence. In other words, no key red flags here in terms of this rally continuing to the upside on the daily time frame. I am noticing slight divergence here on the weekly time frame, not confirmed yet because we don't know if this is a new higher high. I mean, we know it's going to be a new higher high, but we don't know if this is going to be the high point of this rally. So momentum making a lower high when price makes a higher high, that is negative divergence. It does indicate capitulation. But again, interest rate declining environment, everyone, for 2024. So we have to keep that in mind. We saw the same thing happening in 2020 and 2021 when interest rates were declining. Price was making new higher highs despite the negative divergence. So I'm not really looking too much into the negative divergence that we see when it comes to the major equity indices. We know they can be overbought for an extended period of time, and that negative divergence in a low interest rate environment doesn't really indicate all that much. IWM, the Russell 2000 ETF. So we're looking at small caps here, underperforming once again. So after the period of outperformance, we've seen quite a few weeks now of underperformance. Price after breaking above 196 failed at the 200 major resistance zone and has started to pull back here, heading towards that 188 support level. So small caps, obviously when you compare it to large caps, is underperforming, and momentum also gives the same picture with momentum really unable to move higher. But this 188 level of support seems to be holding firm, which is also the 38.2 fib. And I do think the risk to reward favors the upside at 188. So we have the 200 level of resistance as well as the 210 level. That'll be the next key level that I'm looking at, which is the 23.6 fib level. So there's some potential upside, but if you're talking relative performance against the large cap names, IWM is definitely underperforming. Now, TLT, the Treasury Bond ETF. TLT has moved lower as yields have actually moved higher in recent days. So initially we had some support confirmation just below 94 at around or just above 93. Price did show some very strong momentum heading towards the $100 level, but with the rise in yields, we have seen price actually decline. Again, this comes from a more hawkish Fed than anticipated, and the fact that interest rates could be elevated for just a bit longer. So when it comes to the overall outlook for TLT, I am still bullish. We have some support here, and the risk to reward does favor the upside from that level. And again, interest rate declining environment, yields will eventually move lower, and that is going to make bonds move higher. So a stark contrast to the thesis that we had for really almost 2 years, which was overwhelmingly bearish. We were actively looking for areas to sell TLT. Now we're looking for areas to buy TLT. And this support zone at the previous swing level is definitely one of them. The US dollar, with a rise in yields, the US dollar is naturally going to rally, and it has now rallied above that 104 key level, which we saw initially provided some resistance. Now, I would say we started to see a shift in structure, maybe some capitulation here, price forming now a higher low and now potentially a higher high. So heading towards the next major resistance zone at 105.50. I would say it'll be very difficult for price to break above that level, considering that, again, interest rate declining environment, yields will eventually move lower. US dollar index is going to be under pressure. But that's one side of the equation. The other side of the equation, I'm looking at the other central banks. They're all still not in a position to cut interest rates, But when they are, the performance of those currencies is going to decline relative to the other currencies that they're compared against. For example, the US dollar is compared against the euro, the yen, um, the pound. And once those central banks start cutting interest rates, we're going to see the relative performance of the US dollar improve. And therefore, that could act as a potential tailwind for the US dollar. So going to, for now, say 105.50 is a resistance level that price would probably respect. Um, but again, very much dependent on what the other central banks do and not only the Fed. Okay, gold. So gold is still squeezing this major resistance zone 192, 193. The structure in the short term does remain bullish. We are seeing price continuing to make higher lows, but respecting this major horizontal resistance. This is a multi-year resistance zone. So for now, I would say the risk to reward, even when we get a rally towards that level to retest it, does favor the downside. And with the US dollar actually finding some strength, we may not even see gold find that rally. We could see gold actually start to consolidate even further and turn a bit more neutral, which it already has been. We are seeing signs of that with momentum actually declining, turning negative for the first time in a few months yesterday. So I would say gold, very tricky to trade, but you probably, due to the lack of momentum, if we do get a rally, you're looking to sell into that rally because momentum isn't that strong. And I don't think we'll get a breakout above what is a major resistance zone. Looking at light crude oil futures, price has pulled back quite drastically in the last few days after breaking out above that 76 level. So we were once again back at this range, this very tight range between 76 and 70, a lot of consolidation, a lot of choppy price action. And once again, it reflects the lack of a fundamental catalyst. We're not really seeing that fundamental catalyst to dictate where price could potentially head to, hence why we're seeing such choppy price action in the last few weeks, as well as momentum now turning negative after that initial breakout. So not too much to discuss here for oil, to be honest. Okay, sector rotation. We now have 4 sectors in the improving and leading categories. We have 7 in the lagging and weakening. Now, in the leading categories, we have communications showing an improvement in terms of relative strength against the broader markets, so remaining quite resilient in this leading category. But we also have technology, a big rotation down from the leading into the weakening category. Definitely not ringing any alarm bells, in my opinion. Technology has provided a lot of leadership in recent weeks, so it's only natural to see a bit of rotation out of it. And this is good news because once we see rotation out of technology, we are now seeing rotation back into the other sectors here in the lagging and improving categories. So it indicates broadening participation and potentially broadening leadership as well, should this continue. I still believe that there's a risk on sentiment in markets, but the pullback in technology is timely. It also provides good buying opportunities in the future. So this isn't bad news just yet. Now, in the improving category, we do have energy. I expect to see energy start to underperform in the next few days, considering that oil prices have declined. We also have financials making a comeback after a poor start to earnings season, looking to rotate into the leading category. And in the lagging category, one name that I am looking at is actually discretionary. So discretionary traditionally performs very well in a risk-on environment. And so far it has been, I would say, underperforming, but it started to show signs of improvement heading in towards that improving category. And our defensive sectors and utilities, staples and healthcare also showing signs of an improvement in terms of momentum against the broader market, heading in towards that improving category. Now, moving on to some subsectors of interest, DRIV, the Autonomous and Electric Vehicle ETF. This has been a name that we have been bearish on for quite some time. 2350, we saw price retest that level, fail, heading lower. I'm still looking for price to reach the 21 area or 2150. That will be my target price. So I'm going to keep this one open, see how it performs, especially with Tesla, after earnings, bit of a pretty big decline. So I do have a bit more of a bearish view here on this ETF. And IBB, the other subsector that we've been looking at, the biotechnology ETF, Price is still respecting our thesis of staying above what this 133 level. Set to open a little bit lower this morning, and ultimately this is a credit spread idea. So the neutral price action and the choppiness is actually beneficial as theta is working in our favor. But it hasn't exactly moved that much higher. I think now is a good time to close this trade, even though it hasn't invalidated our thesis. The fact that there's just a lack of momentum. You can see momentum declining, but price still maintaining above 133. Indicates this is a strong level of support. But I think now is the time to close it and take those profits, because it doesn't look like we're getting that move towards 145 that we originally anticipated. Okay, Oracle. Oracle, big legacy technology name, which is why, I still like it in a risk-on environment, as it tends to be slightly lower beta than the higher growth technology names. We saw a bit of a pullback followed by a very nice rally here in the last few weeks. So we've been bullish on Oracle. It's approaching a minor resistance zone at around 118, but the upside target that I'm looking at is 120. That's the next key level that I'm looking at for Oracle. And for now, trade is going quite well. Bullish structure remains strong, and there's no reason for us to close this trade just yet. Lows was another bullish idea that we had. Thesis was that price stays above 210. So far, it has been doing that. I would say when price retested this 210 level a few days ago, that would have been a good time to maybe close the trade. But for those of you that did keep it open, so far it is doing quite well. Good credit spread opportunity because of the fact that it's not necessarily moving all that much higher, but it is staying above 210, which is our thesis for the trade. So lows for now, still very much in line with our thesis. We have Rockwell, which unfortunately went against us in a very bad way. So earnings came out, big gap down from the 300 level towards 250. We were bullish at around just above 300. And in retrospect, a good time to have gotten out of this trade was probably the day before earnings, given the fact that price just didn't move that much higher, and you don't want to take additional risk on that trade. So we would have got out at about break even, but if we kept through earnings, unfortunately, we did see a gap down higher here for earnings with no positive bullish price action at this key level to indicate that we could get a recovery. This is definitely one to close immediately. Moving on to C Limited, bullish idea. So far, so good. It has reached a minor resistance zone at around 42. We've been bullish on this when it was at around 38. This is where you'd probably want to take partial profits and let the rest of the trade run towards that 46, 47 major resistance zone. I'm not expecting a big move to the upside because of, the fact that C has been a pretty strong underperformer, but we are experiencing a range-bound market, which allows for us to utilize credit spreads and play the range. We're also seeing price pretty close or at this overbought condition. Even though I think there's further upside, we may see more consolidation over the next few days. So now is that good time to take partial profits. And finally, the new idea, we have ARM Holdings. This is an earnings play. We have earnings tomorrow evening. And what I like about ARM, one, semiconductor name, we know semiconductors have a generally good forecast for the next few months. But what I like about this is that it's pulled back quite nicely ahead of earnings. Was it 80, a little bit overextended, pulled back towards a more modest level where momentum has declined nicely, and showing some bullish price action set to open a little bit higher this morning. So this does provide a very good risk reward bullish entry point. Again, no obvious targets to the upside. We do have an $80 previous swing level, but with earnings, we could see a jump up even higher. So that's why I'm looking at this as a potential earnings trade. And for those of you that haven't really traded earnings before, I highly advise you to watch a webinar that I did about a month ago on how to trade earnings season. And maybe if you're new to earnings, and I know it can be quite intimidating, it can be a big move in a short space of time. So you do want to equip yourself with the knowledge and education to understand how to navigate through earnings. Definitely do not take this trade without watching that webinar, or unless you've already done a lot of earnings trades in the past. Okay, with that is all I have time for today. Big thank you to all that joined, and I will see you next week, Tuesday, for another market outlook. Have a great trading week, everyone.